let me try to make it very clear. You're not confused about Forex fundamentals because it's too complex. You're confused about it because you were taught it the wrong way. First, they make you memorize 50 indicators. Then they give you some textbook labels, like NFP above expectations equals bullish for the dollar. So they tell you to buy, and then what happens? Obviously the market does exactly the opposite of what I teach you. So in the next 10 minutes or so, I'm going to show you what you need to understand about fundamental analysis if you want to start making sense of it. Because once you see things properly, a lot of things start to make sense. So to begin with, let's test the logic that most traders are taught. The Federal Reserve cuts interest rates by 25 basis points. Okay. Is that bullish for the dollar or bearish for the dollar? Well, most traders would immediately say that is bearish for the dollar because a rate cut means a weaker currency. That's the textbook definitions, and it's not totally wrong. Problem is that it's incomplete. That's what makes it tricky, because when you trade with an incomplete model, you end up being confused and you end up being caught on the wrong side of the market. Most traders look at central banks and central banks' decisions like they're straightforward events. A rate cut equals bearish, a hold equals neutral, a rate hike equals bullish for the currency. It's clean, it's simple, it's straightforward, it's easy to understand, but that's just theory, okay? Because the market is not looking at it that way. What we need to understand is that the market is always looking ahead. Here's what I mean. In many cases, by the time the decision is announced, traders have often already spent days, even weeks sometimes, building expectations around that event. That means that the actual rate decision often is already priced in, and by the time it actually drops, the market has already done its move. Now you started to understand that actually the rate decision is not the main variable. At least it's not at the moment of the interest rate decision, because it was before, because the market priced that in and it moved accordingly. Bearish for the dollar, a rate cut is bearish for the dollar. So it moved into the event pricing that rate cut, but by the time it actually printed, by the time the Fed actually cut interest rates, the market did the exact opposite. So here's where the confusion starts, because newer traders are staring at what? They're staring at the headline number. They're staring at the 25 basis point cut. And they're thinking, the textbook definition is a rate cut is bearish, so why is the dollar rallying? It spiked a little lower, but now it's rallying. Why so? Well, the market is reacting to something deeper. In this case, Powell, the Fed chair, telling that rates don't have to come down as much as they thought, and they don't expect more rate cuts. So let me put it this way. The rate decision tells you what the central bank did today. The forward guidance tells you what the central bank is going to do next. And markets care far more about what's next than what actually happened, okay? And I mean, for trading purposes, we have to focus on what's next. The expectations out of an event, the expectations into an event is important to trade the leading up to the event, but after the event actually happens, what we need to understand what the market is going to move based on that event, we need to understand the expectations out of that event, the expectations for what will happen at the next event, at the next 2 meetings, at the next 3 interest rate decisions, and so on and so forth. That's the shift you need to make if you want to understand fundamental analysis, in this case particularly interest rate decisions, but this is just an example. This is true for all sorts of events. Market moves on expectations. The lead up to the event is one thing, and the after the event is another thing. Whether it's central bank decisions, economic data, geopolitics, the market is always asking what's next. Not what just happened, okay? This is important for the lead up to the event, but after it, it's important what's next. This is the part that most traders never learn about fundamental analysis. Now, before I bore you too much with all this talk, let's make this real again with the example. Again, the market goes into the central bank meeting expecting that 25 basis point cut, so bringing interest rates lower from 4% to 3.75%, a 25 basis point cut. First of all, notice the front running of that interest rate cut ahead of the event. That's the, again, expectations into the event. It's important, but I cannot stress this enough. Always keep in mind that the market moves on expectations. It's always about what happens next, after the event, So if you understand this, before the interest rate decision, well, what was next? The actual 25 basis point cut. And so the market was trading the what's next, because before the interest rate cut, that was the move ahead. But after the interest rate decision, the move was no more cuts, no more cuts. So into the interest rate decision, the market, well, this should be something like this, the chart, but whatever. The market priced that interest rate decision with dollar weakness, okay, ahead of the event. But what most traders do, they laser focus on the event itself and they get caught on the wrong side, because a newer trader sees the rate cut and thinks, well, that's bearish for the currency. They just cut 25 basis points. Yes, but put that into context. And what happens also at the same time, the chart spiked a little first to the downside. So at some point, the chart actually looked exactly like this, which could fool traders into thinking, well, okay, this is bearish for the dollar because it's moving lower. They just cut 25 basis points. Yes, it did react to the cut for a couple of minutes or so, which reinforces that idea into the trader's mind to chase this move. But then the real variable comes in. In the press conference, we got the forward guidance from Powell. He starts saying how he thinks they're done cutting for the cycle. Hear this out.
Thank you, and I look forward to your questions.
Howard Schneider with Reuters. Just referring to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. And also, I would note that having reduced our policy by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And the cut quickly became old news, okay? Obviously, as you've seen, it didn't actually say blatantly they don't expect more rate cuts. Central bankers' language is a little bit different, and I've done a full video on that. You can check it out. But basically translating what he said, that they expected to be in the neutral range for the interest rate, so no more lowering of it. So quickly, the interest rate decision became news, and the forward guidance actually was what started to move the market ahead, okay? Now, understand what happened here. If you laser focus yourself on what happened, before the interest rate decision, you miss the what's going to happen next. So what's going to happen at the next interest rate decision? And that's what actually moved the market, okay? Do not focus on what happened, an hour ago. Focus on what's going to happen ahead. This is the key in fundamental analysis. The market is not just asking what's going on right now, it's asking what happens next. That's how you need to think if you want to be a macro trader. And so now you can probably see why so many traders feel confused with fundamentals, because they were taught it to focus on the event itself. They are taught to just look at the raw number and ignore everything else. And that way, they're always one step behind the market. Okay, and they're watching what happened, which I don't want you to do, instead of watching what happens next. If you understand this single sentence right here, you've got your fundamentals in the right direction. Okay, so let me push this a step further. Let me show you the part that really brings this together, because at this point you might be thinking, okay, so what matters is what the market thinks the central bank will do next. And that's exactly right. And sometimes that comes directly from the forward guidance. So the central bank itself communicating what they're likely going to do next, like Powell right here in January 2024, hinting at rate cuts at some point during the year. Listen to this.
As you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, we feel like inflation is coming down, growth has been strong, the labor market is strong, what we're trying to do is identify where we're really confident about inflation getting back to 2% so that we can then begin the process of dialing back the restrictive level.
Or even more precisely, sometimes later, same year, 2024, in July, the forward guidance got very precise. Listen to this.
And then I would think that a rate cut could be on the table at the September meeting.
Doesn't get more straightforward than that, actually saying, that they're gonna cut rates at the September meeting. And in fact, watch the dollar, what it did after this FOMC meeting that set the table for that rate cut in September, okay? See what's going on here? They didn't cut rates at this meeting. The market understood what they were going to do, and he started to price that in accordingly. The rate cut actually happened somewhere here. The market focused on what happens next. Right here, Powell said they're going to cut rates in September, so the market did not wait. It started to price that in advance. Forward guidance, expectations for what happens next. So what's the point here? Retail traders, most traders, what they do, they see Powell saying, they're gonna cut rates in September. And so what they do, they wait for September, they look for the rate cut in September. And in September, they're gonna start looking for dollar shorts. No, markets move on expectations. The rate cut in September is gonna be old news already. If Powell said he's gonna cut in September, the market is gonna price that in right now. So that's it. This type of communication, the forward guidance, Powell saying rate cut in September, Powell saying, rate cut is going to start sometime soon. This type of communication can be in the statement, in the press conference, like in this case, and from speeches outside of the interest rate decisions too. But listen to me very closely here. The next point to understand is that central banks do not meet every day. They meet once a month, sometimes less. And comments outside of those events can be quite sporadic. So if the market is constantly trying to price what the central bank will do next, what information is it using in between the meetings? Because it doesn't base itself only on the forward guidance put into, the actual interest rate decision. The market bases itself on a lot of information. So that information that the market is using is the data. The same exact data that the central bank is watching to make its decision. Talk about this extensively in other videos. The data that matters for the central bank is the data that matters for the market. Okay, so mostly labor market and inflation data. So this gives you meaning and context behind an economic calendar like Forex Factory, which again, as you know, you don't need to stare at watching every single piece of data. I've done a full video explaining the 20% of the moves that actually moves the needle for the market and that can be traded. And to make things practical, that's exactly what we've done with this trade on AUDNZD, for instance. We're not just saying, the Australian data looks bad or New Zealand dollar looks bad. We're asking a much better question. What is the data forcing each central bank doing? Not what it forced them to do so far, not what it forced them to do a month ago, but what is it forcing them to do next? In this case, on the Australian side, the picture was tight labor market and hotter inflation. The kind of combination that keeps the central bank hawkish. In fact, right after this combo of data, they hiked interest rates. Okay. On the New Zealand side, the context was quite different, with the labor market actually weakening. So they stayed more dovish. So again, what are we doing here? We're building the case and trading the expectations of what the central bank, in this case, these two central banks, will do next. And we're doing it by understanding how the data will influence both central banks. The RBA hawkish and the Reserve Bank of New Zealand dovish. Okay, we understand the data is going to force them to move in that certain direction. See, most traders will just try to buy the Australian dollar against the New Zealand dollar maybe after the Reserve Bank of Australia hikes interest rates. And sure, that can work if they signal more hikes after that specific interest rate hike. But our task is to anticipate and trade looking ahead. We understand that the data is going to force the central bank to do something versus maybe another central bank to do something different. The rate decision tells you what happened today. The forward guidance tells you what happens next. Now, this illustration here is going to look a little confusing, but focus on this for a second, okay? What we need to do is, first of all, obviously look at the interest rate decision, but after that, understand how things are going to evolve for what? The next interest rate decision. After a meeting is done, after an interest rate decision is done, we don't care about that interest rate decision anymore. We care about what happens next. We care about the forward guidance. We care about the speeches outside of that interest rate decision, because maybe the central bank governor or the central bank chair is going to talk, in certain speeches and say, well, we're going to hike rates, we're going to cut rates, maybe we're going to do this and that. Also, we care about what? The data, which we understand is going to influence whether the central bank actually hikes or cuts interest rates. And that, or this, builds the picture for what? For what's going to happen at the next interest rate decision. And this is what builds a trend, okay? If you learn to read this properly, then at that point, you can call yourself a macro trader. Okay, and this is the bigger lesson about fundamental analysis. You're not just tracking events, on a Forex Factory calendar. You're not just watching the calendar, seeing the high impact news events, watching if it prints green or red. That's retail mindset. I really want you to hear this part. A lot of the confusion comes from learning a version of fundamentals that is just textbook style. Okay, it's the type of definition that you find in a textbook, but it's not applicable to the real markets. You were taught to memorize definitions instead of watching expectations. You were taught to react to events instead of understanding what the event means for what happens next. You were taught to focus on the interest rate decision itself instead of watching the path that decision implies. So, to put it very simply, if you want to be a macro trader, you need to understand expectations. The expectations adding into the event and the expectations coming out of the event, and what influences those expectations for what? The next event. Once this clicks, your whole perspective begins to change. And I understand this is not going to be fairly easy to understand. This is complex, but this is what it is. And if you want to understand more about this, I've got loads of videos that cover specific topics in particular. Now, when you see a rate cut, you're not going to say immediately, that's bearish for the currency. What are you going to do? You're going to ask what was expected, okay, before the interest rate decision, how the market moved, what was priced in, what changed in the statement with this interest rate decision, not just the interest rate decision, but actually what changed around it. Did they change the tone? Was the central bank more hawkish, dovish, or about the same? What does this mean for the next meetings? So what is the forward guidance? Will they keep cutting, or maybe they're gonna stop cutting? This is a much smarter process, and it's a process that actually works. So if you learn something new in this video, understand it can be a little bit confusing, but if you put in the effort to understand this, it's gonna pay its dividends. So make sure to like the video and subscribe to get more of this knowledge.